Institutional investors treat global sports franchises like standard corporate assets designed to yield a cash return, assuming the entity is actually trying to maximize profit. Professional sports clubs do not operate like traditional businesses. They are quasi-firms. Their primary objectives are win maximization, acquiring trophies, and projecting geopolitical prestige. Wealth generation for shareholders is a distant, often non-existent priority. This diagram identifies the core reality of the club as a dissipative hulst. It is a vessel structurally designed to incinerate working capital on the pitch. While the club burns cash, wealth is systematically extracted by external actors, creditors, shadow investors, and intermediaries. This chart displays the structural math behind the burn rate. Player payroll inflation consistently absorbs 60 to 80% of total operating revenues. The margins required to absorb an exogenous financial shock simply do not exist. Deploying standard corporate valuation models to a vessel engineered to bleed cash results in extreme mispricing. Investors end up absorbing massive capital expenditure traps and unprovisioned structural risks because the baseline math assumes a profit that will never arrive. Looking at this breakdown of valuation failures, we see that discounted cash flow models collapse entirely. DCF requires an eventual positive cash yield. Apply it to structurally negative cash flows, and it mathematically returns an arbitrary zero, failing to price the physical assets. Attempting to use EBITDA multiples is equally flawed. Applying a multiplier to a negative number generates a useless figure for institutional underwriting. Even industry-specific frameworks like the Markham multivariate model contain critical algebraic flaws. Markham features revenue in both its additive base term and its multiplicative profitability term, creating a double counting error known as the quadratic revenue bias. Because of this mathematical overlap, clubs with massive top-line revenues receive exponential spikes in their estimated value. The model completely ignores whether the club has disastrous cost controls or massive operational deficits. This equation is the deficit sustenance valuation engine. It is a strict forensic correction designed to strip away speculative accounting and isolate exact asset value under distress. To deploy capital safely in this environment, analysts must discard hypothetical forward cash flow projections. The math must pivot to establishing a rigorously defended hard floor price. The first variable in the DSV equation shown here is ALV, or asset liquidation value. This represents the absolute physical floor, the physical real estate of the stadium and the playing squad. This is not the standard audited book value. Standard accounting relies on static figures. ALV strictly measures the acute, forced liquidation cash realization of the entity's holdings. To price the squad, the architecture uses the Tilly model. The squad is a portfolio of options and liabilities. On the left, inventory drag, overpaid players on mathematical anchors deducting from value. On the right, liquidity yield reprices academy players based on market demand. Player values are then subjected to the liquidation velocity penalty. Theoretical market value drops severely when capital must be recovered immediately, outside of standard summer transfer windows, to service senior debt. By mathematically netting the high-demand liquidity yield against the heavy contractual anchors and applying the friction of velocity, the model isolates a true executable number. This stress-tested squad valuation establishes the defensible upper bound physical asset ceiling, setting the stage before any operational liabilities are factored in. Unrecorded senior cash drains like origination points on debt and opaque third-party intermediation fees. This reveals the true function of the transfer wealth mechanism. The club's ongoing operational loss is what drives the yield for external creditors and agents. Every emergency cash injection generates new opportunities for fee extraction. Alongside the deficit, this enforces a provision for systemic, unprovisioned risks. This buffer captures submerged threats, omitted liabilities, undisclosed image rights disputes, and hidden contractual earnouts standard audits miss. Failing to capitalize the grossed-up operational deficit and enforce these strict escrow buffers guarantees that incoming capital will walk blindly into a highly structured insolvency trap. The final step shown in this section is discounting these capitalized liabilities. Here, the DSV equation introduces bespoke adversarial variables. Applying generic stock market discount rates to a football club relies on highly efficient market assumptions. In a volatile quasi-firm ecosystem, relying on a standard weighted average cost of capital is analytical negligence. Standard metrics are discarded for a specific sports beta. This rigorously quantifies the macroeconomic stability of the domestic league, upcoming broadcasting rights volatility, and the devastating cash flow shock of potential relegation. Finally, we apply the toxic alpha penalty. This is a graded numerical haircut applied to the discount factor for severe regulatory risk. Fair play violations trigger immediate points deductions. Because deductions geometrically increase relegation probability, toxic alpha mathematically penalizes any lack of financial compliance. By enforcing this adversarial discount rate, institutional capital is proactively shielded against the systemic wage inflation and rigid contractual liabilities unique to the sports domain. The valuation architecture is now complete. We take the stress-tested acute asset liquidation value and aggressively subtract the capitalized cost of the structural deficit and contingency buffers, discounted by adversarial risk. This diagram shows the resulting variable, the hard floor price. It strips away all accounting illusions to provide the only defensible, intrinsic baseline for institutional capital deployment. The deficit sustenance valuation engine is engineered explicitly for economic defense. It actively protects deploying buyers against a financial biome designed to drain equity. In a market dominated by dissipative hosts, the hard floor price stands as the sole mathematically sovereign truth.